Well, U.S. job numbers for March came in slightly better than expected. The economy added almost 200,000 jobs, far better than in February, which had left economists worried that the U.S. economy was slowing down. The unemployment rate held steady at less than 4%, while average hourly wages for private sector workers grew over 3% from a year earlier. Well, with me now to talk more about what the numbers mean is Elizabeth Crofoot, Senior Economist in Labour Markets at the Conference Board. Welcome to the show.
Thank you for having me.
So let's start with your overall impression of this nearly 200,000 jobs created in March.
Well, it is a very impressive performance by the labor market for sure. Like you said, nearly 200,000 jobs were created. Unemployment stayed steady at 3.8%. And, from the February jobs report, if there were any inklings of recessionary pressures, those fears were largely allayed with this strong report. But there are still some concerns. I mean, the manufacturing sector, for example, did see a decline in jobs, and that's the first time we've seen that type of movement since July 2017. And another sector is the temporary help industry, which generally has been seen as a leading indicator of employment growth. So if we do see that ticking downward, it's something to watch going forward because it might be a sign of more employment declines in the future.
And we certainly did see that recession word tossed around when we saw February's numbers, 33,000 jobs created, and compare that to what we saw in January, 312,000 jobs. What was behind the drop that we saw in February?
A lot of this, we need to remember that it is a survey. They are data that are collected, and there is a large margin of error. It could go anywhere from more than 100,000 to less than 100,000 of that particular data point. So it's better to look, or better to think about it in terms of a longer trend, maybe looking at the 3-month trend or the 6-month trend, rather than focusing on any one single month data point. So it's really a blip.
And you raise an interesting point because a lot of people were essentially split over this jobs data. We obviously did see this historically low unemployment rate, wage growth picking up, but then you have some people saying wage growth is still too weak, and also that the jobs are too unevenly split. We're seeing a fewer number of these high-skilled, high-paid jobs and a growing number of these poorly paid service sector jobs. A lot of people expect automation to essentially continue to keep chipping away at. What are your thoughts on what this advance in automation will also mean for the future of jobs growth?
Actually, right now on the lower end of the skills spectrum is where we're seeing a lot of growth and a lot of potential. So you're talking about lower wage growth. Actually, it's the blue sector or blue collar workers and low paid services workers that are seeing higher wage increases than their white collar, higher skilled or higher educated counterparts. So there is a lot of movement in that area in terms of wages. In terms of automation, I would say that there's a lot of potential for automation to work with current workers and to continue to increase their skills and to increase their wages as they enable them to work with this new technology moving forward.
But even as there is job growth in some of these lower paid jobs, though, even if you have a wage increase, it's still at the lower end. There's still that big skills gap. We know what's being done to address that?
There's a lot of conversation right now about what can be done. Some solutions speak to working with communities, community colleges, vocational programs, really trying to identify what are those skills that workers need, what are employers looking for, and where can colleges and universities sort of mend that gap.
Now, from what we saw with this latest data and some of the trends, obviously we know that the Fed doesn't expect to raise interest rates at all this year. Any indication that that might change after this most recent jobs report?
Well, it really depends on how the Fed was seeing it going into this jobs report. If the primary concern was recessionary pressure, well, then this report is painting a completely different picture. Really, it's highlighting the strength of the labor market right now, and also with the hourly wages, the wage growth going down from 3.4 to 3.2%. That's also signaling that it's not going to have much inflationary pressure going forward. So I think that they may reconsider, but for the most part, it seems like they're going to be staying still with their current position.
And just quickly, there does seem to be headwinds in other sectors of the economy, but the labor market does seem to still be growing steadily. So what would you say is your overall outlook for the U.S. economy?
Well, it is, we are expecting the employment growth to start to decline, the growth rate will just diminish. We are expecting employment to continue to grow, however. So as economic growth also declines, we'll see in turn those numbers start to go down as well. But there are some, like you said, the headwinds in terms of, trade tensions, and also the government shutdown didn't help much. But there are also some challenges for employers. For example, profits. There is going to be challenging to increase profitability in the future, as we're seeing wage increases are climbing more steadily. So companies are going to have a harder time sort of offsetting those wage pressures, since they don't have a lot of room to maneuver in terms of offsetting them with price increases as well.
All right, Elizabeth Crofoot there, Senior Economist in Labor Markets at the Conference Board. Thanks so much.
Thank you.